Welcome to Talk Tickers. We're here to give you the crucial insights from today's big earnings calls without you having to sift through all the corporate speak.
That's right.
Today, we are diving straight into the Warner Brothers Discovery Q1 2025 earnings call.
And it was, well, quite a revealing quarter, especially when you look at their streaming division. Seems like they're really firing on several cylinders there.
Yeah, absolutely. The big number that jumped out for me was the subscriber growth in streaming. Over 5 million new subscribers just in Q1. That's pretty strong.
It really is. And importantly, it's not just about, adding users. It's actually hitting the bottom line. Streaming delivered, $339 million in EBITDA.
EBITDA, right. For those tracking, that's a key profitability measure. And they're not stopping there, are they? They're projecting much bigger numbers.
Exactly. They're on track, they say, for at least $1.3 billion in EBITDA for the full year 2025.
Okay, wow.
Yeah, that's like an 85% increase year over year. So it really shows the growing financial power of their streaming side.
And they've got that big subscriber target too, right? Something like 150 million.
Surpassing 150 million subscribers by the end of next year. So yeah, definitely a bullish outlook there.
Okay, so streaming is clearly a highlight, but the studio business, the traditional side, that's also moving along towards its $3 billion EBITDA goal.
Yeah, they mentioned progress there too. So overall, looking pretty solid this quarter, I'd say.
All right, so let's dig a bit deeper then. What exactly is fueling this really impressive streaming growth?
Well, a big part of it seems to be sticking to high quality content, especially from HBO. They talked about having their deepest, most consistent storytelling pipeline.
Right.
And they pointed to shows like, White Lotus, The Pitt, The Last of Us, and even international stuff like Sinners and Eastern Gate.
Those are definitely the kind of shows that create buzz, aren't they?
Yeah.
The ones people sign up for.
Exactly. It feels like a deliberate focus on sort of prestige drama and their big IP, maybe less focus on just sheer volume now, targeting maybe a more engaged audience that's willing to pay.
That makes sense. They also seem to stress local content, didn't they? Local language shows and local sports, making the service more relevant globally.
Yeah. Absolutely. You can't just have a U.S.-centric service worldwide. That tailoring is key for growth in different regions, and they're pushing that global expansion hard.
Still room to grow there.
Oh, definitely. They said almost half the world is still untapped potential for them. Key launches coming up early next year, Germany, the UK, Italy. So, yeah, significant runway internationally.
Okay, so great content, global push. What about the actual app, the platform itself? Are they improving that side?
They are. They mentioned product improvements focused on personalization, keeping people engaged. And they said there's a strong roadmap for, future enhancements, making it stickier, basically.
Right. And another thing that seemed quite successful was that cheaper ad-supported tier. That seems to be pulling in a lot of subscribers.
Yeah, that's definitely a big driver. It's in over 45 markets now. It's kind of an easier entry point for people who are maybe more price sensitive.
And it brings in ad money, too. They said international ad revenue is growing strongly.
Exactly. Dual revenue, stream subs and ads. And that international ad growth, that suggests their global strategy there is starting to pay off.
Okay, now something every streamer is wrestling with.
Oh.
Password sharing. Sounds like WBD has a plan.
They do. They expect their efforts there to really pick up steam later this year and into 2026.
How are they actually doing?
It sounds like a clearer, maybe firmer messaging about the rules. And they're rolling out an extra member add-on option.
So pay a bit more to share legitimately.
Kind of, yeah. Reinforce the rules, but also offer a paid way for others to watch. Convert some of those non-paying viewers.
Makes sense. And are they looking at other ways to boost ARPU, the average revenue per user?
Oh, yeah. Several things. Advertising, obviously, as that tier grows. That extra member feature directly adds revenue. Plus, they hinted at strategic price adjustments in some places. And upselling things like sports, especially in Europe, seems to be part of the plan, too.
And bundling. That Disney bundle in the U.S. seems to be working out.
Early signs are good, yeah. The Hulu, Disney Plus, Max combo, they're seeing lower churn, reaching a broader audience. So these kinds of partnerships look promising.
Okay, interesting. Let's switch gears now and talk about the studio side of the business. What were the main takeaways there?
Well, they really highlighted the strength of Warner Brothers Television, called it the world's leading independent TV studio.
Independent meaning they sell to others too, not just Max.
Exactly. They produce content for lots of platforms beyond their own. Think Ted Lasso for Apple, Abbott Elementary for Disney. It diversifies their income.
Smart. Okay, and on the movie side, the motion pictures.
It's kind of a two-pronged strategy. Big blockbusters, based on their major IP. They mentioned the Minecraft movie. Upcoming Superman, Supergirl, Lanterns films. That's part of a whole 10-year DC plan.
Wow, 10 years.
Yeah. And a new Lord of the Rings movie just announced, too. So leveraging those huge franchises, but also investing in compelling new original films alongside those.
It really sounds like they're leaning heavily into those core IPs, DC, Harry Potter, Lord of the Rings, Game of Thrones, treating them like massive long-term assets.
Absolutely. They even compared them to something like the NFL foundational assets you build on for years, even decades, like the Harry Potter plan, also 10 years apparently. And alongside building their own IP value, they're still licensing older library stuff and making originals for others, like we said. Scooby-Doo for Netflix was another example. So it's a balance, exclusivity for Max versus broader monetization.
Right, finding that sweet spot. Now, with all this streaming growth, are they just pouring tons more money into content spending overall?
Actually, no, not significantly. They said increases will be moderate. The interesting part is they expect a higher proportion of Warner Brothers output to be used internally on Max.
So building asset value for future streaming profits that way.
Precisely. Being more strategic, more efficient with the spend, rather than just throwing money at volume.
Got it. And they mentioned gaming briefly, too.
Yeah, just that some restructuring is happening there, and they expect it to be a growth driver longer term. Suggests they see potential, but are tweaking things.
Okay. And generally just trying to get everything working together better. Collaboration, franchise management.
Exactly. More integration, better processes across the whole content chain. That seems to be a big internal focus for long-term success.
Okay. What about the wider economy, the macro environment, advertising market? Any major impacts there?
They said no material impact observed recently from the macro stuff, which is, somewhat reassuring.
And advertising specifically. How's Q2 looking?
Tracking pretty much in line with Q1, they said, once you adjust for a few factors they'd mentioned before.
Okay. Stable for now. What about the outlook? Like the upfronts?
They think the upfront market, where advertisers commit budgets way in advance, might start a bit slower this year, but the scatter market that's ads bought closer to the air date is apparently quite strong right now. They see that as a potential offset.
Interesting dynamic.
Yeah. And they also stressed they're ready to manage costs if things look worse in the second half. Said they already took some precautions after those recent tariff announcements, so being watchful.
Good to hear they're prepared. Okay, let's talk sports. Their strategy seems a bit different depending on where you are in the world.
That's right. It's not one size fits all. In some markets, sports are just baked into Max. In others, it's an extra add-on you can buy.
And is it working?
Well, outside the U.S., they said sports combined with local shows, and HBO is a real differentiator. Driving demand, pulling people in.
Okay. What about here in the U.S., though? Premium sports rights are expensive.
Yeah, in the U.S., it sounds like they're still experimenting, trying to find a model for premium sports in streaming that's actually sustainable, balancing the huge cost of rights against, how many subscribers it actually brings in and keeps.
It's a tough nut to crack.
It really is. And interestingly, they seem to be emphasizing a shift towards focusing on their owned IP as the core assets, rather than, as you put it, the rental business of sports rights.
So maybe less reliance on renting expensive sports long term, more focus on building value with DC, Harry Potter, etc.
That's the feeling I got, a strategic pivot.
And there's a change coming with the NBA rights too, isn't there?
Yes. Big change. They expect sports rights costs to drop significantly in 2026 when their current NBA deal ends.
Okay.
There is some overlap costs this year. 2025, they estimated around a $300 million increase for the year, with Q2 getting hit pretty hard. But the longer-term trend for sports expenses looks better for them.
And they managed to renew other deals even without the NBA.
Yeah, they specifically mentioned renewing affiliate deals successfully, even with the NBA situation ongoing.
Okay, so wrapping things up for investors, what's the sort of the bigger picture narrative here?
I think the main points are restructuring into those two clear divisions, studios and streaming, gives them more transparency, more options maybe down the line.
Right.
The focus on quality content over just quantity is key to their whole strategy, driving subs, driving engagement. And ultimately, they're presenting this combination. A growing global streaming service, a top-tier studio with incredibly valuable IP, all supported by the cash coming from their linear networks. They see that as the foundation for, long-term sustainable growth and value for shareholders.
Okay. Clear enough. Right, it's time for our This Is Not Financial Advice segment. Based on all that, got any outrageous but plausible trade ideas for us?
Okay, outrageous but plausible idea number 1. Given how much WBD is emphasizing owned IP, Lord of the Rings, DC, Harry Potter, and building these long-term franchise plans, maybe think about the ecosystem around that.
Cool.
What about looking into companies that specialize in, like, transmedia storytelling or franchise management? The firms that help take a big IP and exploit it across games, merchandise, experiences, everything.
The picks and shovels for the IP gold rush.
Kind of. As WBD and others really doubled down on maximizing these huge franchises, the companies that help them do that could see, an unexpected boost. Speculative, but plausible.
Interesting. Okay, give us one more.
All right, number 2. Connects to that password sharing crackdown. WBD says they're getting tougher adding the extra member thing. It suggests a broader industry trend, right? Tighter control over who's watching.
Yeah, seems likely.
So maybe a speculative play on cybersecurity firms, but specifically ones focused on digital rights management, secure identity verification, multi-factor authentication, particularly those working within media and entertainment.
So betting that the tech needed to enforce these new rules will be in higher demand.
Exactly. As streamers try to monetize every viewer, the tech that enables that control could see a surge. Again, outrageous, perhaps, but you can see the logic.
2 very interesting ideas there. Food for thought, definitely. But remember, everyone, this is purely for informational discussion, absolutely not financial advice. Always do your own thorough research before making any investment decisions.
Definitely. So, to sum up, the Warner Brothers Discovery Q1 call showed real strength in streaming, a very clear strategy focused on quality IP, and generally a positive outlook fueled by quite a few different growth levers.
We really encourage you to dig into the filings yourself. Keep an eye on this whole fast-moving media space. What parts of WBD's strategy make sense to you? What challenges do you see? We'd love for you to join the conversation. That's all for this deep dive. Until next time on Talk Tickers.